Greetings, traders. Today, we're delving into the intricacies of market liquidity, particularly in the Forex and stock markets, and how smart money traders can leverage it to trade like pros. Understanding liquidity in Forex and stock markets is essential for traders to navigate the market effectively, minimize trading costs, and capitalize on profitable opportunities. So if that's something you're interested in, smash that like button and subscribe if you're new. Let's dive right in and uncover the secrets of smart money trading strategies. Alright, welcome back. Now let's first understand liquidity. What is liquidity? Market liquidity in stocks and Forex refers to the ease with which stocks or currency pairs can be bought or sold without causing significant price movements. Here's how I can explain it better. Let's say you're on Euro to US dollar chart and you want to buy this pair at this price. For that to be achieved, there must also be a seller who is also willing to sell the same pair at that same price. Furthermore, both categories have contributed to market liquidity. Now understanding how liquidity is reflected on trading charts, smart money traders can make more informed decisions and better navigate the dynamics of the Forex market. Let's move to types of liquidity. In the Forex and stock markets, there are two primary types of liquidity. 1. Bid-ask spread liquidity. This type of liquidity is represented by the difference between the bid or buy and ask or sell prices of a currency pair. Tight spreads indicate high liquidity, while wider spreads indicate lower liquidity. Have you ever opened a chart, especially the pound sterling to US dollar around 1 a.m.? If you've ever, I think you observed that during this period, the spread are very wide. So this indicates that there is no bid-ask spread liquidity in the market around this period. And if you realize, at this time we find the London and New York markets closed. 2. Depth of market liquidity. Depth of market liquidity refers to the volume of buy and sell orders available at different price levels. A deep market with ample liquidity allows smart money traders to execute large orders without significantly affecting prices. For example, pound sterling to US dollar and euro to US dollar are traded more during London and New York market sessions because of large volumes of orders available during these times. Now, those are the only types of liquidity. I guess you're asking yourself, how about buy-side and sell-side liquidity? Aren't they types of liquidity too? Well, these are not, but stick around. I'm going to show you where these lie. So if you're enjoying the video, just hit the like button and subscribe. This gives us more energy to create more videos for you. So where does smart money liquidity rest? Smart money traders, comprising institutional investors and large financial institutions, strategically position their liquidity to maximize trading efficiency. Here's where smart money liquidity typically rests in the Forex market. Major currency pairs. Smart money traders predominantly focus on major currency pairs like euro to US dollar to Japanese yen, and pound sterling to US dollar due to their high liquidity and trading volume. Take an example on euro to US dollar. It has tight spreads due to its high liquidity, and it's one of the most traded currency pair due to its large trading volume. Smart money also rests their liquidity in different market sessions. For example, smart money traders are most active during liquid trading sessions, such as the overlap between the London and New York sessions, when trading volume is at its peak. So, how do smart money traders use liquidity to their advantage? Well, it all starts with understanding market structure and identifying key levels of support and resistance. These levels are where liquidity tends to cluster, as they represent areas where a large number of buyers or sellers are likely to be waiting. So there is always large amounts of placed orders and stop loss near these support and resistance key levels. Buy stops and stop loss around resistance level represents a level that is termed as buy-side liquidity by smart money, whereas sell stops and stop loss near or around support level represents sell-side liquidity. When smart money traders analyze a chart, they pay close attention to these levels of support and resistance. But they don't just blindly enter a trade when price hits these levels. Instead, they wait for confirmation that liquidity is present and that the market is likely to move in their favor. One way they do this is by looking for price action signals, such as pin bars, engulfing patterns, or other reversal patterns that indicate a potential shift in market sentiment. These signals, combined with an understanding of liquidity, can help smart money traders pinpoint those perfect entry points with a high probability of success. Another technique smart money traders use is order flow analysis. By monitoring the flow of buy and sell orders in real time, they can gauge the level of liquidity at different price levels and anticipate where price is likely to react. This allows them to enter trades ahead of the crowd and capitalize on price movements before they occur. So guys, let's move to the final topic of this video. Here I'm going to be teaching you two strategies that you're going to be using while trading levels with liquidity in financial markets, and these strategies are breakout and pullback strategies. Let's begin with breakout strategy. Here we have three categories: continuation breakout, reversal breakout, and false breakout. Continuation breakout. The first step in trading continuation breakouts is to identify the underlying trend. We want to trade in the direction of the prevailing trend to increase the probability of success. In this case, we'll use 4-hour as our higher time frame and 15 minutes as the lower time frame. On 4-hour, after knowing the direction of the trend, we then mark fair value gaps and order blocks that we expect price to reach. Once we've identified the trend, fair value gaps and order blocks in higher time frame, we then move to 15 minutes time frame and look for key levels of support and resistance where price has consolidated or paused before continuing in the direction of the trend. These levels act as potential breakout points. Patience is crucial when trading continuation breakouts. Instead of entering the trade as soon as price approaches a key level, wait for confirmation that the breakout is genuine. Look for a decisive break of the support or resistance level, preferably accompanied by strong volume. Now for this category, we'll only enter a trade if we see a momentum candle getting out of this range and closing above or below the range. This signals strong volume in the market. Furthermore, we only have two entry techniques to apply here. We can use entry orders such as buy stop orders above the resistance level in an uptrend or sell stop orders below the support level in a downtrend. This allows us to enter the trade automatically once the breakout occurs, without the need to constantly monitor the charts. Or we can also wait for the price to test these levels before continuing in the right direction on the trend, and we can enter at the retest. Reversal breakout. The first step in trading reversal breakouts is to identify potential reversal zones on the chart. These zones typically occur at key levels of support and resistance, trend lines, or chart patterns such as double tops or double bottoms. Look for areas where price has previously reversed direction, or where there is confluence of multiple technical factors indicating a potential reversal. On the chart, we start by analyzing if the price has reached our higher time frame key levels such as fair value gaps, order blocks, or even higher time frame support or resistance levels. We then move to lower time frame to look for reversal patterns. Once we've identified a potential reversal zone, exercise patience and wait for confirmation that the reversal is underway. We then look for price action signals such as bullish or bearish engulfing patterns, hammer, or shooting star candles. Confirmation helps filter out false signals and increases the likelihood of a successful trade. After the confirmation, we now enter the trade of the retest or use entry orders such as buy stop orders above the resistance level in a bullish reversal or sell stop orders below the support level in a bearish reversal with 1 to 2 risk to reward ratio. Moving to false breakouts, we don't trade them, since trading false breakouts can be challenging. So let's move to pullback trading strategy. Trading with the trend after a pullback is a common strategy used by traders to capitalize on the resumption of the underlying market trend. Smart money, typically institutional investors or large market participants, often enter trades based on similar principles, aiming to buy low in an uptrend or sell high in a downtrend. Here's how we can trade with the trend after a pullback on a chart, along with insights into how smart money might enter the same chart. The first step is to identify the underlying trend in the market, and this can be done on higher time frame like 4-hour. Once we've identified the trend, wait for a pullback or retracement against the trend. This is a temporary reversal in the direction of the trend, where the price retraces part of the recent move. Smart money often waits for these pullbacks to enter trades at more favorable prices, so we'll use Fibonacci retracement levels, and we'll only want to enter a trade if the price is below or above 50% Fibonacci levels. Still in these levels, we'll want to look for fair value gaps, demand, and supply zones. Once the price reaches a potential fair value gaps demand or supply zone, we then look for confirmation that the pullback is ending and the trend is resuming. This can be done by looking for a change of character on 15 minutes chart. Once we have confirmation that the trend is resuming, we then enter the trade at the fair value gap that caused a change of character. Now let's get to some real chart examples. Here on pound sterling to US dollar 4-hour. It's an uptrend with price making higher highs and higher lows. When we view closely after this recent break of structure to the upside, price left behind this fair value gap, there is also this demand zone. So we have identified the trend. Now we want to see if this pullback is a temporary reversal in the direction of the trend. We then use Fibonacci levels by marking from the low to the high of the swing leg. Remember, we only want to buy entry confirmation once the price is below 50% Fibonacci level and respects either the fair value gap or the demand zone. Price retraces and fails to respect this fair value gap, however, it respects this demand zone. We can also see this bullish engulfing candle. This confirms the retracement is over and that the trend is resuming. Now we have entry confirmation. We then move to 15 minutes to find perfect entry points. So on 15 minutes, we have a change of character. We can also see that price left behind a lot of fair value gaps that it will come back to fill. There is also this level that has caused a lot of confluence to the price in the past. So we'll also focus on the same level. We can then wait for the price to reach this level and can enter our trade. As the price reaches this level, it respects it. So we enter our trade setting stop loss below this level and take profit targeting the next level of liquidity in higher time frame. So guys, remember, no trading strategy is foolproof, and it's essential to practice proper risk management. Always conduct thorough analysis and backtesting before implementing any strategy live in your trading. That's all for today, folks. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more trading tips and strategies. Happy trading, and I'll see you in the next video.